Something just broke in the Middle East, and the financial media is already spinning it as a diplomatic setback. A minor gestation in negotiations, a temporary pause. Move along, nothing to see here. Do not move along. What collapsed in the past 72 hours between Washington and Tehran is not a negotiation failure. It is a load-bearing wall being pulled out of a global supply architecture that most investors have never bothered to look at. And if you are sitting on the sidelines tonight, watching silver prices tick up and wondering whether to take it seriously, then you are asking the wrong question entirely. Stay with me, because what follows is not speculation. It is a structural forensic analysis of why this specific geopolitical collapse lands differently in 2026 than it would have landed in any prior decade. My name is OG Peter. This is SilverDispatch, and tonight we are not here to give you hot takes. We are here to give you the architecture. Let us begin where serious analysis always begins. Not with prices, not with headlines, with systems. The global silver market is not a simple commodity exchange, it is a pressure network. Raw ore moves from mines in Mexico, Peru, and Kazakhstan. Scrap and recycled silver feeds in from industrial streams. All of it must pass through a refining pipeline before it becomes deliverable, exchange-grade metal. That pipeline processes approximately 1.3 billion ounces annually across roughly 40 major facilities worldwide. Now here is the number that anchors everything that follows. The world has consumed more silver than it has produced for 5 consecutive years. A cumulative physical deficit exceeding 800 million ounces between 2021 and 2025. The Silver Institute projects the 2026 deficit alone at over 46 million ounces. 5 years of the world spending its silver savings account while nobody at the mainstream level told you the account was running low. That deficit was already a pressure system waiting for a trigger. Iran just pulled the trigger. Iran sits at the intersection of 3 things that matter enormously to silver markets. First, it is a primary transit corridor for physical metal moving between Asian refining hubs and Middle Eastern industrial buyers. Second, its energy infrastructure is deeply intertwined with global shipping lane stability through the Strait of Hormuz. Third, and this is the part almost nobody is discussing tonight, Iran is a significant secondary processor in the silver recycling chain that feeds European industrial manufacturers. When the peace framework collapsed, all 3 of those pressure points activated simultaneously. And the market is only beginning to price what that actually means. To understand why the US-Iran collapse hits silver specifically and hits it hard, you need to understand what was already broken before the negotiations fell apart. Between December 2025 and January 2026, 3 of the world's most significant silver refineries suspended or severely restricted operations within a 21-day window. Johnson Matthey's Salt Lake City facility, Metalor in Switzerland, Heraeus in Germany. Combined, those 3 operations represented approximately 68 million ounces of annual processing capacity. That is roughly 9.7% of the entire global refining pipeline, gone dark inside of 3 weeks. Asahi Refining and Umicore followed within weeks. Another 58 million ounces of annual capacity restructured or withdrawn. Formal advisories issued stating they were not purchasing new silver intake until further notice. When you remove capacity from a parallel redundant system, you lose that percentage of output, and the rest compensates. But silver refining is not a parallel redundant system. It is a sequential pipeline. Remove a critical node, and the pipeline does not reroute. It backs up. Downstream does not slow. It runs dry. The financing mechanism that accelerated this collapse deserves your full attention because it explains the speed of what happened. Major institutional refiners had for years extended zero-interest working capital advances to smaller regional processors. Margin advances that allowed smaller operators to carry silver inventory through 30 to 60-day processing cycles without needing the balance sheet to sustain it. In October 2025, those advances were slashed from effectively 100% coverage to as low as 30%, with market interest charged on the remainder. Within 24 hours of that change, regional processors could not sustain their commitments. Backlogs exploded to 3 and 4 months. The financing failure came first. The operational shutdown followed as a consequence. Now layer the US-Iran collapse on top of that already fractured infrastructure. The Strait of Hormuz handles approximately 21% of global petroleum transit. Energy price volatility directly affects smelting and refining operational costs. When shipping lane risk spikes, insurance premiums on physical metal transit spike with it. When insurance premiums spike, the marginal economics of operating an already stressed refinery tips further into negative territory. The operators who were already barely sustaining commitments under the margin advance collapse now face rising operational costs from an energy market that just received a geopolitical shock. And meanwhile, the demand side is not softening. Solar manufacturers consumed over 25% of annual global silver supply in 2024. EV demand for silver jumped an estimated 20% in 2025. Defense procurement chains, activated by the same geopolitical tension now driving the Iran collapse, are pulling physical silver for electronics and munitions at accelerating rates. Supply is contracting, demand is expanding, and tonight's collapse just tightened both ends of the vice simultaneously. If you have been following SilverDispatch for any length of time, you know that OG Peter does not bring you a story without giving you the structural forces underneath it. Tonight, there are 3. And each one is more consequential than the last. The first force is the COMEX inventory situation. Between 2020 and early 2026, registered silver inventories on COMEX, the metal actually available for immediate physical delivery against futures contracts, declined from approximately 346 million ounces to approximately 76 million ounces. A 78% decline while futures contract volume remained elevated. In January 2026 alone, in a single week, 33.45 million ounces were physically withdrawn from COMEX registered inventory. 26% of the entire deliverable pool, gone in 7 days. The coverage ratio currently sits at approximately 13.4%. Exchange analysts flag below 15% as stress territory. We are in stress territory. The US-Iran collapse just sent institutional buyers back to the physical window at the worst possible moment for inventory depth. The second force is China's strategic repositioning. On January 1, 2026, China implemented silver export licensing requirements, reclassifying refined silver as a strategic resource rather than a freely traded commodity. China controls between 55 and 70% of global silver refining capacity. When Western refiners went dark, the assumed overflow valve was Chinese processing. That valve is now controlled by a government that has decided silver belongs to China's industrial future, not to Western buyers facing a supply crisis. The US-Iran collapse deepens this dynamic. China has strategic interests in Iranian stability. A collapsed US-Iran framework pushes China further toward consolidating its own resource position. The geopolitical chessboard and the silver supply chain are now moving in the same direction, and that direction is tighter. The third force is lease rate behavior. In any ordinary supply environment, 1-month silver lease rates sit between 0.3 and 0.5% annually. By late December 2025, those rates had surged to between 7 and 8%, with some institutional sources citing figures above 15%. When lease rates go parabolic, the signal is precise. The remaining holders of deliverable physical silver are demanding emergency premiums to part with their metal even temporarily. That is the price system communicating genuine operational scarcity. Since the US-Iran collapse broke overnight, lease rate data is showing renewed upward pressure. If what OG Peter is laying out tonight is the kind of structural analysis you cannot find on mainstream financial channels, then hit subscribe on SilverDispatch right now. Because what comes next is where this story moves from explanation into real-time consequence, and you need to be in the room when it happens. The mainstream resolution narrative is already forming. You can hear it in the financial press tonight. Tensions will de-escalate, back-channel diplomacy will resume. The silver rally is a knee-jerk reaction to a headline, and prices will normalize within weeks as the situation stabilizes. This analysis fails on 4 specific grounds, and OG Peter is going to give you each one clearly. First, the refining capacity that went dark is not returning on any predictable schedule. Asahi's new Salt Lake City facility is in a construction phase with no defined completion timeline. Domestic U.S. silver refining capacity is widening its gap, not closing it, in real time. A diplomatic resolution with Iran does not rebuild refinery infrastructure. Second, no single institution has the authority to force resolution. The Federal Reserve does not manage commodity supply chains. The CFTC regulates derivatives, not physical metal flows. The Department of Energy cares about green energy supply chains, not COMEX inventory coverage ratios. Every relevant institution has partial jurisdiction. None has comprehensive authority. That governance gap does not close in a quarter. Third, even if refining throughput normalizes completely, it does not replenish the 800 million ounce cumulative deficit. It stops the drawdown from accelerating. That is a fundamentally different outcome from resolution. The savings account does not refill, the bleeding merely slows. Fourth, and this is the point that the paper market is most aggressively ignoring tonight, the silver that institutional buyers are pulling from COMEX registered inventory is not coming back. Strategic accumulation does not reverse. When the actors who move markets decide that physical possession carries a premium that paper contracts cannot replicate, they do not sell that conviction back into the market because a peace negotiation resumed. So here is the question that ought to stop you cold tonight. Silver is trading around $78 per ounce as OG Peter records this. The paper market is reflecting a futures system whose registered inventory coverage sits at 13.4%, whose financing infrastructure suffered a cascading collapse beginning last October, whose primary industrial consumers are competing simultaneously with defense procurement chains, institutional accumulators, and energy infrastructure build-out, and whose most critical geopolitical backstop just collapsed overnight. What exactly is that paper price measuring? Because it is becoming increasingly difficult to argue that it is measuring the cost of acquiring physical silver in the world that actually exists right now, in 2026, tonight, after everything this analysis has laid out. The gap between what the paper says and what the physical market reveals is the most important data point in this entire story. And it is receiving the least attention from the institutions whose entire purpose is to pay attention. This is OG Peter at SilverDispatch. As always, this is for education and discussion only, not personal financial advice. The comment I want from you tonight is this. Do you trust the paper price of silver after what the US-Iran collapse just revealed? Or has the physical market already quietly broken away from it? Drop your argument below. The most interesting perspective wins the conversation.